I'm Mike Blake. I have a company called High Score Strategies. We're a business valuation and strategic advisory firm with offices in Atlanta and outside of Lisbon, Portugal, where we moved almost 8 months ago. The valuation of software is a fairly complicated topic. We can only cover the surface. To the extent we can, we'll dig deeper if there are questions. As an added bonus, absolutely no additional charge. Should you find any spelling, grammar, syntax, or mathematical mistakes, you may keep them. And that's a personal offer from me to you. Over the course of my career, I've found that there are 5 most common applications for the valuation of software code. Traditional lenders will lend money using software code as collateral, and it becomes collateralized when the code is transferred into some sort of escrow account. There's a whole cottage industry around that. You may need to determine the value of software code for financial reporting purposes, most likely in connection with a purchase price allocation. The value of software code may come up in litigation. Also, transaction support. There are companies that buy and sell software code. In fact, I'm working with a company right now that has what I think is a fairly valuable software application for a niche market, and I'm advising them on how to sell that. And finally, you may need to know this for purposes of complying with gift tax. I have worked with clients in the past that transferred software code to a charitable organization, and they wanted to know what the value was, and a qualified appraisal of the software code will be required to accompany the tax return. So we all know that software is different. The software code that drives our operating systems, our telephones, our security, our versions of Minecraft, whatever they are, we all know that they're different. But from a technical valuation standpoint, how do they differ? Valuation theory recognizes that there are 6 dimensions by which software differs from one another. One is lines of logical code. And this has become increasingly important, that distinction of logical code. And not just logical code, but logical code that is proprietary. A lot of software now is being developed using open source code. The distinction as to whether logical code has been developed organically or has been pulled from open source is an important distinction, as is whether code is executable or not. Code will have a lot of lines called remarks and comments that are not executable, but they're basically intended to be a set of breadcrumbs that enable either that particular programmer or those that work with or succeed the programmer that wrote the code initially to have a better understanding as to what code they're looking at. Fault tolerance is an important distinguishing factor. There's some software, for example, Minecraft, that if it fails, crashes, it's not the end of the world. On the other hand, if software fails at 40,000 feet on a 787, that obviously can be disastrous. There's the opportunity cost of developing software and taking the time out to do that versus buying software. And of course, the functionality of software itself will differ from application to application, and indeed version to version, not just versions that are advanced over time. But as we all know, there are certain pieces of software that have professional versions, consumer versions, trial versions, beta versions, and so forth. Now, there's another dimension to software that I want to bring up. Software actually can have debt. Generally speaking, there are 2 types of debt that matter from a valuation standpoint. One is called functional debt. And functional debt is a characteristic of software that is missing, but is needed for the software to realize its full value. There's an acknowledgement that there are functionalities missing from the software that need to be added later in order for the software to be considered a completed project. The owner of the software effectively owes, if you will, is called functional debt. Things that the software doesn't do now. The other form of debt, which is just as important, is called technical debt. And technical debt means the degree to which a software has been made harder to work with as an engineer or a programmer or developer in order to accomplish short-term goals. Sometimes, in order to meet the deadline, a programmer will be forced to make some hard choices, which means that they may choose to write code in such a way that provides the minimum or desired functionality today, but makes it harder to build upon that code later. Okay. We call that technical debt because what that approach to coding means is that when you want to add a feature, and that feature could be something as fundamental as improving the security of the code, that other code will have to be rewritten, in effect, rebuilding some of the foundation of the software code so that it can be built upon properly. And technical debt can go on for a long time. That technical phenomenon does have a financial impact because it makes the code more difficult to continue to ensure its utility going forward. And we call that concept technical debt. I'm going to set forth 6 different valuation methodologies today, and I'm going to focus on the final 4. We have 3 approaches when we talk about intangible assets, such as software code. We label those approaches the market approach, the income approach, and the cost approach. Starting with the market approach, establish value by comparing the price paid and accepted for similar assets in the marketplace and comparing the characteristics of those assets to our subject asset. So ideally, what we would like to do is we'd like to find and somehow identify software that is similar to the software code that we are seeking to value ourselves today. Okay. Most common multiple is dollars per line of code, which is a very ham-handed way of valuing software, but it bears mentioning because it is widely used. But unfortunately, we don't generally observe active markets that are publicly observable for software code. So if we're going to use a market-based technique, we have to be willing to make some leaps of logic and to be a little bit creative and step outside the textbook, I think, in order to at least approach something that looks like a reliable value. So one idea might be to infer the value of software based on public companies. And the thesis is this, is that if a company is small enough, and I define small by amount of revenue, especially if they're a publicly traded company, I would argue that those are effectively publicly quoted prices of the underlying intellectual property or intangible asset. And what I've presented here is about 15 or 16 publicly traded companies right now that are in the software space that have annual revenue of $100,000 or less. I would make an argument that these companies are effectively being valued based on the underlying intellectual property. It couldn't be a valuation of their customers because they don't have very many of them. It probably isn't value of non-competition agreements. It probably isn't value of trademarks or copyrights because, again, they're not selling anything. So how would the copyrights have a great deal of value? So simply by the process of elimination, I argue that these could be construed without too much squinting as publicly traded software code. It's not out of the realm of possibility that software code could have valuations or could have defensible values. One thing I will acknowledge is I think that those values do incorporate goodwill. Now, we know from empirical data that for software companies, when they are purchased, 52% of their purchase price is allocated to goodwill. If our median enterprise value is $1.1 million and 52% of that is goodwill, then the remaining value is going to be $500,000 and change. And I can see that if we take a very rough rule of thumb of $10 per line of code, and $10 to $15 per line of code is something I've heard quoted a lot as that rule of thumb. Now, What about transactions? So I'm always interested in understanding what transactions are telling us about the value, because I'm reticent to take a position that I'm smarter than the market. So, take a few software acquisitions. There have not been many software acquisitions that have been disclosed, at least that I could find. But there have been a few that involve very low transaction values, which I think indicate that they are most likely purchases of the underlying software. Okay. We have to dive much more deeply into these transactions to understand them, but at least I do think that it's a credible place to start. Oh yeah, Robert. Yeah, let me get to your question. The general price for a line of code. So lines of code are determined as proprietary, i.e. non-open source, logical or executable code. So blank comments, remarks, as I would call them, because I'm ancient, that's the last time I programmed, they would not be counted. A rule of thumb for software code, somewhere between $8 to $15 per line of code. I've seen it as high as 25, and I've seen it as low as even 2 or 3. But that, hopefully that answers your question, gives you a general range. If we take these transactions as being indicative of software, of their underlying software, and assuming that 58% of the value is accounted for by goodwill, then the implied software is $960,000 or so. Do these techniques work? I'll be the first to admit it's a little bit of a stretch, but I haven't encountered anything that is better. And I do think that where intangible assets are involved, I think a lot of practitioners give up a little bit too early for my taste on trying to identify market metrics or market indicators of value. But this is the kind of thing you're not going to find in a textbook. I would not use this as the basis for expert testimony, because there's a very good chance you'd be subject to a successful Dauber challenge. But I think in other areas where more creativity is permitted and encouraged, particularly on the transaction side where I live, it's another tool. And if nothing else, if you're determining the value of software using other techniques, this can be a way to at least sanity check your other methodologies that are more conventional. And of course, establishing comparability is extremely hard. We're never going to know for sure how many lines of code, executable code, the respective software packages have. We may never even be able to fully establish their functionality, because you may have to buy the software to study it. And you may not be able just to buy one seat. It may be enterprise software. They only sell the 500 seats. And so it may not be practical, as odd as it sounds, but it may not be practical to establish the functionality of competing pieces of competing applications. Establishing comparability is hard. Where intangible assets are concerned, it's at least 3 to 5 times as difficult, but it's still worth thinking about. So moving on to more conventional valuation techniques, the income approach. And the income approach establishes value by equaling it to the value of the sum of the cash flows that we expect in the future, discounted by, adjusted for risk, using what we call a discount rate, which is supposed to be the required return to make that investment, in this case, investment in the software in the first place. And there are 2 methodologies of significance using income under the income approach for valuing software. One is the relief from royalty method, and the other is called the multi-period excess earnings method, which is a mouthful. Relief from royalty itself is an awkward wording. So I'll give you the textbook definition, and I'll give the definition of how I think about it. The textbook definition of relief from royalty means the royalties that if I own the software, I don't have to pay somebody else for access to it. So I'm being relieved of the obligation to pay royalties. To me, that's a little backwards. I actually think of it as the owner of the software. were I to license it and collect royalties, this is the value of the software to me based on the fact that I would collect those royalty payments. To me, that's just a little bit more, a little bit easier conceptually to grasp, but it means the exact same thing. So if you grasp the textbook definition more easily, then great. Don't need to change, don't need to do anything. And so a relief from royalty model is in effect what I call a cousin of a discounted cash flow model. A somewhat distant cousin, but a cousin nevertheless. And just as a discounted cash flow model seeks to compute and then estimate the cash inflows that I would expect to receive as the owner of a business, the relief from royalty model does the same thing, but the difference is that the source of the cash flow for a business is going to be the operation of the business itself. I sell hamburgers for $1 a piece, and I make 25 cents on each hamburger, and give or take some adjustments, that's the cash flow, the profit that I make from the hamburger. In a licensing model, and it sounds great, I don't operate any business other than writing a contract that allows somebody else to use my software and then pay me a royalty, usually a percentage of the revenue, in order to use the software over time. And in many cases, I can license that software over and over again. Very few licenses are truly exclusive anymore. And so that's a good model, because for the most part, the licensee, the one who's the party that's licensing the software, paying the royalties, assumes all the operational risk. And so the projected income statements are quite simple, where if we have an understanding or a prediction as to what the revenue the software is likely to generate over a period of time, in this case, I've taken 5 years because that's the median useful life of software. We'll dig into that a little bit later. And if we assume a 15% royalty rate, and in my experience and in my research, most business-to-business software royalty licensing rates are between 10 and 20%. And so I'm just splitting the difference. You pay tax on those royalties, that's what the 25% gets to. And so we have net royalty income. We then are discounting the net income as it comes in, because we have to wait for it. It doesn't all come to us all at once. That would just be a cash lump sum payment. For simplifying the analysis, we're assuming that's not taking place. And so we have this time value of money adjustment, or if you're in finance, it's called the present value. And the present value is simply the compounding rate of return that is required, which is why this time value factor, as we move ahead in time, decreases. And for purposes of this discussion, I'm not going to get into how I came up with the 19%. That's beyond the scope of what we're trying to do today. But we determined that 19% is the appropriate return. So this factor that you see of 0.92, 0.77 is being multiplied by the net income. And that is converting future dollars promised to us into present dollars today, which dollar to dollar, they are being discounted. And then if this model is accurate and reliable, then the value of the software comes out to be $115,000 and change. There are many problems with the relief from royalty method, but the biggest one is that it assumes that the licensor has no expense involved in sustaining that royalty income. And in the real world, that's just not the case. If you're licensing software, you have to send bills, you have to monitor the royalty fees coming in, you have to enforce your intellectual property rights against infringement. And so there are expenses to that, and they may not necessarily be massive expenses, but they do exist. And in my view, a plain vanilla royalty relief from royalty model will tend to overstate value by a little bit. And in a modified relief from royalty model here, we would add this line item for maintenance expense. Now, you might notice, if I haven't put you to sleep yet, that the fair value of the software in this scenario is actually greater than the fair value of the software here, even though we've actually added an expense item and we have reduced the royalty income. The reason for that is because in adding this maintenance expense, I am making an assumption that I'm extending the useful life of the software, right? So software doesn't just write itself. Over time, you need to close bugs, add security features, add other features to keep the software competitive. And if you make that investment to maintain the software in that way, then you can extend the useful life of the software. That's why Microsoft Windows is able to survive in this current version for, I don't know when Windows 11 came out, I guess about 4 or 5 years ago, and it's going to last for another couple of years. They do that because they issue those updates, right, fairly frequently. In fact, they make your computer harder to use until you actually execute those updates. I'm sure we've all encountered that. I do think it's important to recognize that when you maintain the software, it's not just a throwaway maintenance cost of business expense, but it does add value because part of that expense you're undertaking is being reinvested in shoring up the value of the software and preventing the software value from deteriorating. I'm going to talk towards the end of this program about how we capture that value deterioration for software. Now, the other method that is used for, at least frequently used for determining the value of software, is called a multi-period excess earnings model. And the multi-period excess earnings model attempts to isolate the economic value to all of the operations. The first facet is that this is no longer a model that is predicated on the receipt of licensing fees, but rather is predicated on the actual operation of the software itself in order to generate profit for the business, right? So you don't see royalty expenses and tax on net income. And we also see in the middle here something called a contributory charge. Under the relief from royalty model, we can see these mechanics down in the bottom third of the page, where again, we are discounting those expected future cash flows at a compound rate of 19%, okay? And just for clarification, by the way, this 4% for software expenses means it's growing at 4%. I know that's not 4% of 220,000, so it's a rare case. I actually didn't make a math error. I think both of these models have a place, but I think that they have a different place. They're better for different purposes. You know, a relief from royalty model, of course, is computationally simpler than other models, but nevertheless, it works very well if the commercial goal of the royalty of the software is to monetize it by licensing it to other parties. So it actually reflects the economics of the operation of the software. Whereas excess earnings is more complex, but I think I can argue that it's a more comprehensive model. But I also find it more satisfying if the intended use of the software is for the current owner to operate it, because it captures the economics from an operational perspective more holistically. So the income approach, I think particularly for financial reporting and probably for litigation as well, is probably the preferred of the three approaches. And I think because of the detail and the way it captures risk, because data is typically available. And I think it does okay at differentiating software. And the weaknesses of the income approach in software valuation are identical to those that we encounter in business valuation. You can argue all day long over whether the projections are reliable, are credible, are valid. It's going to be an argument that never ends. And some people will argue that the income approach is a somewhat artificial method for determining the value of any asset. And I agree, it is highly artificial. It's a theoretical model, and it's just that. It is in fact a model. Finally, I want to cover the cost approach. And the cost approach establishes value by the amount of money that was either invested to create the asset in the first place, or the amount of money that would be required to replicate it. And I think of these two, the more popular methodology is called the historical cost method. And it's as simple as it sounds. The historical cost method for valuing software indicates that the value is roughly equal to whatever the originator of the software invested to create the software in the first place. Okay. And so I have created here just a dummy example with various cost classifications. So hang on to this, take a snapshot of it if you like, if you think you're going to be valuing software, because in any information request pertaining to the valuation of software, you should be asking specifically about these particular costs to make sure that you're capturing everything that needs to be captured. As you might imagine, salaries are going to be the biggest line item because, again, AI is good, but it's not that good. Software code does not yet write itself. And the total expense, again, for this particular case is about $1 million and change. Now, because ongoing research and development under most accounting and tax systems can be expensed as incurred, we should be determining the cost on an after-tax basis. And for simplicity's sake, as in the prior examples, I've assumed a 25% tax rate. And when you factor in the taxes that you don't have to pay because you spent these funds on developing the software in the first place, we are concluding a value of the software of about $791,000. Now, an important assumption here is I'm assuming 1 year of development time. If the time to develop takes longer, then salaries will go up for sure. Almost all of these expenses will go up, often in a linear way. So if it takes 2 years to develop the software, then the value may very well wind up being just shy of $1.6 million. So in particular, when using the historical cost method, it is critical to understand the time frame that would be required in order, or was required, to produce the software in the first place. Now, I'd like to present to you my favorite, and this is, no joke, my secret weapon for valuing software. I call it my secret weapon because it makes me look way smarter than I actually am. 10 years ago, I discovered something called a constructive cost model, version 2, COCOMO for short. And this is a model that was developed over the course of about a decade by a gentleman named Barry Boehm. And he came up with a pretty clever model to answer a question: if we were to set out to develop a piece of software with X characteristics, how much do we need to budget for that software development project? And it turns out that it's also useful for determining the valuation of the software, because if we assume that the software would cost $1 million to reproduce, then the potential buyer for the software has a decision to make, right? It's the old make or buy discussion that all of us had in our introductory accounting classes. And so we try to anticipate, okay, if the buyer could either buy the software from me, or the buyer could go off and make it themselves, which is the best way for them to go economically. Now, even though most of you likely have not heard of this model, it is quite robust. If you're going to use this model, I highly recommend buying these 2 books. They're out of print, but they're not terribly expensive still. They're not exactly page turners. It'll take a while to get through them. But they have been used by expert witnesses in court. They have been used by the Big Four for determining fair value of software. They have been successfully used in IRS matters, and there have been academic studies that have back tested this model, and the model has held up pretty well against actual software development costs. Now, COCOMO 2 works by estimating the cost of producing software depending on how many lines of code there need to be in the software, the relative degree of difficulty in writing that code, the number of person hours required, the cost per hour, and the cost per hour required. And we figure out the number of person months based on the overall effort required that must be invested in order to create this software. And the guts of the COCOMO 2 formula is this, a fairly simple form. There's not even a Greek letter in sight. And in valuation and economics, if you can get away with no Greek letters, you are in such good shape. But if you know the number of thousands of lines of logical executable code, and the EAF, the effort adjustment factor, which I'm going to go through in a minute, you already know these 2 constants. They've been established by empirical studies. If you can do this very basic, it's not even arithmetic, it's just algebra, you can figure out the overall effort required, which then is going to translate into the valuation. So these effort application factors on an individual basis range from very low to extra high. And as you can see, there's a value that's associated with most of them, and some of them are just not applicable. And these have been determined by empirical study. And so when you determine the rating for each one of these factors, you simply apply the corresponding score. So in this case, we're assuming, or we've been told, or we've learned that the required reliability of the software is nominal. And so therefore the EAF score is 1, meaning that it doesn't have a positive or negative effect on the software development budget. The next one, size of application database, is relatively low, so it's going to reduce the effort involved with the software developing the software. It's going to reduce the cost as an EAF of 0.9. Developed for reusability. This gets into technical debt. Okay, if the software needs to be developed at the outset to make sure that the code can be reused, that's going to increase the effort required to develop the software, resulting in a high EAF rating and a 1.07 in this slot. And we just go down the line, and then the combined EAF score is simply multiplying all of these numbers together. Okay, so they are multiplicative in nature. Now, working through the math, assuming that we have 150,000 lines of logical code, we've got our EAF of 0.66, which is pretty low. We learned these 2 constants earlier, 2.94 and 0.91, and we simply crunch to the math. So now we know the number of person months that are required. We choose to assume 160 hours a month of effort. In this case, we chose the cost per hour of $76 or so. I think that was the 75th or maybe 90th percentile for software engineer wages in the US at the time, for a total development cost of $2.2 million. Now, these expenses are subject to a tax deduction, just like in the historical cost method. The net cost to produce after the tax deduction is $1.68 million. Now, I've added something to this model that not everybody does, but I add a required return because I think there needs to be a discussion of this model to capture the opportunity cost of developing the software. If a company were to take a year to develop this software on their own, which they could, lots of software can be reverse engineered, and although some software is patented, that's the exception rather than the rule. There's an opportunity cost to not using that software in the market. And also there's an opportunity cost to tying up your capital to make the investments required to develop the software. In this case, I happen to assume a very high required rate of return, which is 40%. It's probably a high risk venture. And so that brings our total cost, our total value, which is also our cost, of just shy of $2.35 million. So we have two different methodologies into the cost method. I think the historical cost really is useful now as something to compare against other methods. You might be able to get away with it if the costs were incurred within the last 2-3 years prior to the valuation date. But I think more than that, software technique and tools develop so quickly, and we're seeing software development change again or evolve again rapidly with the advent of language learning models and generative AI. I think it's more useful at this point as a comparison tool rather than a primary valuation tool, though I do think it's better than nothing. I like Kokomo too because it does consider the technical facets of the software code. You really have to dig in and understand the nature of the code, and I think it enhances the credibility of the valuation. It helps that it's held up well to empirical testing. And also, of course, it's very helpful that the model itself has gained wide acceptance in many of our constituencies that are relevant to the valuation industry. Generally speaking, the cost approach does have its merits, I think mostly because of all the approaches that it uses the most reliable inputs. When you talk about historical costs, what you spent, right? If nothing else, you know that answer. It's probably not subject to debate as long as your accounting records are accurate. And I think companies also do a pretty good job of developing their software development plans. And I think they have a pretty good idea of what it would cost to replicate the software. I think they certainly have a handle on the technical facets of the software. And either of these models is generally very simple to execute, and simplicity is good. If it gives you a good answer, there's no reason to invent complexity. But the big glaring weakness is that the cost approach is not forward-looking unless it's somehow modified. That is a big minus, and that's why I've tried to plug that hole, if you will, in the Kokomo 2 model, because that opportunity cost factor adds a forward-looking element to it. So how does Kokomo go with lay juries? I am not an expert witness. I haven't tried it as an expert witness. I think as much as anything, I think it's going to rely heavily on the attorney and the expert witness. How well can you explain it? The good news, again, there's no Greek letters. The math is fairly straightforward. And is Kokomo harder or easier to understand than a royalty method or a multi-period excess earnings method? I don't know. But I do know, as I said before, it has been used in testimony at court and it has been accepted. I think the exposure to a potential Dauber challenge is very low. But in terms of juries, I think so much there depends on how strong an expert witness you have in explaining complex financial concepts. Now, there are a couple of adjustments I'd like to talk about with respect to these models, and I'm saving them toward the end because they apply to all the models in one respect or another. And one of those models accounts for the fact that software becomes obsolete over time, just like almost any other asset. Very few, I know some assets are assigned an indefinite useful life, but most software does not have an indefinite useful life if it's not maintained. And so my favorite tool for accomplishing this notion of software deterioration over time is called the estimated lifing factor. And the estimated lifing factor has been around since 2000. It's published in the Appraisal Journal by Robert Ellsworth. And he actually published this model as a way to better estimate the useful lives of machinery and equipment. But it also seems to work pretty well with intangible assets as well. And again, although the math looks a little scary just because there are a lot of parentheses, again, if you just know order of operations, you can do arithmetic and no exponents. It's really easy. And what the ELF accomplishes is it creates a survivorship factor, okay? And so this is an important point to understand, because whereas depreciation, we think of depreciation as to how much value goes away or is depleted from an asset over time, the ELF frames deterioration of value from the perspective of how much value remains. And that's why it's called a survivorship model. And so what we see here is a model here that is applying an estimated lifing survival factor year to year. As the software is not being maintained, the code becomes more out of date. And then by the end of year 5, it's going to be at 0. There's going to be no value anymore. And so we can see that the fair value is no longer, I think it was $115,000. It now takes a hit. It's now at $78,000. So the lifing factor is doing its job. And we can also use it for a cost-based methodology. Let's say we're using a historical cost model, and these expenses were incurred 3 years ago, and there have been no expenses incurred to maintain or update the software since then. According to the ELF model, our survivorship factor, if you work through the math, would be 70%. And so 70% of the value would remain, okay? So this is the way we can actually make an adjustment for the fact that code might be maybe old, and therefore it may not be as valuable as code that was very recently written that maybe ostensibly accomplishes the same thing. Now, the other adjustment I wanted to discuss, the tax amortization benefit. And many countries have this. The only difference is the amortization period. In the US, when you buy an intangible asset, you can amortize the purchase price of that intangible asset over your future tax liabilities for a period of 15 years. I think in the UK it's 20, Canada's 25, and I forget what other countries are, but it differs, but in many countries it works the same way. And again, the math is a little tricky just because it's heavily based on order of operations, but again, no Greek letters. And in our particular model, using our discount rate that we've been using of 19% and a tax rate of 15% and a 15-year amortization period, that means our tax amortization benefit factor comes out to be 1.0973. And if we add this to the relief from royalty model, where a survivorship factor has already been applied, the way that it impacts value is we apply that 1.097 to the base value of the software to then produce this fair value of software after the application of that benefit. So it's simply the $78,000 and change times 1.097 equals $85,768. Now, as we wrap up, a few odds and ends I want to talk about that didn't really flow in the normal course of the conversation, but I do want to make sure that I cover. Software patents can be obtained, but I've been doing some research on that, and there's limited empirical research, but the research that's out there seems to indicate, and my patent attorney friends are not going to like this, but there is no statistically significant, there's not been demonstrated or published anyway, a statistically significant relationship between patenting and the value of software. The market just doesn't seem to care. I suspect that is because where software is involved, that good engineers can invent around the code. They can write the code differently. maybe even in an entirely different language. I suspect that's the reason why. Any intangible asset can be subjected to option theory as in terms of evaluation methodology. I just don't see it adding a lot of value here. You could force it into a model, but I just don't see software the same way that I see a patent or a trademark or a trade secret. So you could do it, but I don't think it has much practical application, which is why I did make it a core part of the presentation. But in case you're wondering, I do agree that if you really wanted to, you could use option theory to value software code. Differentiating your subject software from competing packages can be extremely difficult and very time consuming and could require some technical skill. That may be something that you're going to want to engage your client on, or if it's a very complex litigation case, you may actually want to insist that an industry expert rides shotgun with you, because they'll be able to speak intelligently as to whether or not the software that you're valuing is better or worse functionally from others in the marketplace. We haven't talked about research and development tax credit eligibility because each state is different. And this gets into accounting, which I'm entirely unqualified to discuss, but it is out there. And when you do software, you may want to think about whether or not an application or computation of a research and development tax credit as part of the software evaluation makes sense. And then the big question right now in programming, as it is with so many other things in society, is what is the impact of generative AI going to be? I've already seen ChatGPT write functional code in Python. It's basic code, but it works. So with that concludes the formal part of the presentation. If you want a copy of a PowerPoint, just message me or email me. We'll get that out to you.